This building has killed more dreams than any weapon in human history. Not through violence, not through war, but through a quiet, invisible mechanism that has been draining wealth from ordinary people for over a century. This is the Federal Reserve headquarters in Washington, D.C., and what happens inside these walls has destroyed the purchasing power of your money by 97% since 1913. Your grandfather could buy a house on a factory wage. Your father could raise a family on a single income. You need two incomes just to afford rent. This is not an accident. This is not natural economic evolution. This is the deliberate result of a monetary system designed to transfer wealth from the bottom to the top. And the terrifying part? Most people have no idea it is even happening. Let me show you exactly how the Federal Reserve destroyed the American middle class. Because once you see the mechanism, you will understand why everything feels broken, and why it was always designed to break. To understand how the Federal Reserve destroys wealth, we need to go back to 1913. Before the Fed existed, America had no central bank. Money was backed by gold. Banks could not create unlimited currency. If a bank made bad loans, that bank failed. The system was harsh but honest. Then came the panic of 1907. A series of bank runs nearly collapsed the financial system. J.P. Morgan himself had to organize a bailout using his own money. The panic created political pressure to stabilize the banking system. But instead of creating better regulations or requiring higher reserves, Congress did something far more radical. They created a private central bank with the power to create money from nothing. The Federal Reserve Act passed on December 23, 1913, late at night, when most of Congress was home for Christmas. Few understood what they were voting for. The official story was simple. The Fed would stabilize the economy, prevent bank runs, and maintain the value of the dollar. That was the promise. Here is what actually happened. Within 20 years, the Great Depression destroyed a quarter of the economy. Within 60 years, the dollar lost half its value. Within 100 years, the dollar lost 97% of its purchasing power. The Federal Reserve did not stabilize anything. It created the most sophisticated wealth extraction system in human history. Here is exactly how the mechanism works. Pay close attention, because this is the core of everything. The Federal Reserve has one primary tool, the creation of money. When the government needs to spend more than it collects in taxes, which is almost always, the Treasury issues bonds. These are IOUs, promises to pay back the money plus interest. In a normal world, the Treasury would have to sell these bonds to real investors, people with actual savings. But here is where it gets interesting. The Federal Reserve buys these bonds with money it creates out of thin air, literally. A Federal Reserve official types numbers into a computer. Those numbers become dollars. Those dollars buy government bonds. The government spends that money into the economy. This is called monetizing the debt. It is a fancy term for printing money to fund government spending. Now you might think, great, free money for everyone, but money is not wealth. Money is a claim on wealth. When you create more claims without creating more wealth, each claim becomes worth less. This is inflation. Not the temporary inflation from supply shocks or oil prices. Structural inflation. The permanent devaluation of currency that happens when you expand the money supply faster than you expand real production. Let me give you a concrete example. In 1970, the average American home cost $23,000. The median household income was about $9,000, so a house cost 2.5 times annual income. Today, the average American home costs $420,000. The median household income is about $75,000. A house now costs 5.6 times annual income. Housing did not become more valuable. Dollars became less valuable. But here is the critical insight. This inflation does not affect everyone equally. This is where the wealth transfer happens. When the Federal Reserve creates new money, that money enters the economy at specific points. It goes to the government first, which spends it on contracts, salaries, and programs. It goes to banks, which use it to make loans. It goes to Wall Street, which uses it to buy assets. The people who receive this new money first get to spend it before prices rise. They can buy assets, real estate, stocks, businesses at the old prices. By the time this new money trickles down to ordinary workers through wages, prices have already increased. The purchasing power has already been diluted. This is called the Cantillon effect, named after an 18th century economist who first described it. Those closest to the money printer benefit. Those farthest from the money printer lose. Guess which group includes billionaires, banks, and government contractors? Guess which group includes teachers, nurses, and factory workers? The Federal Reserve has created $8 trillion since 2008 through quantitative easing. That money went overwhelmingly to financial institutions and large corporations. It inflated the stock market to record highs. It pushed real estate prices into the stratosphere. The wealthy, who own stocks and real estate, saw their net worth explode. The middle class, who own little beyond their primary residence and maybe a small 401k, saw their purchasing power collapse. Between 2008 and 2023, the wealth of the top 1% increased by $35 trillion. The wealth of the bottom 50% decreased by $900 billion. This is not capitalism. This is not free market economics. This is a rigged system where the Federal Reserve prints money that flows upward to asset owners and never reaches wage earners in real terms. Your wages might increase nominally. You might get a 3% raise. But if real inflation is 7%, you just took a 4% pay cut. And you probably did not even notice because your nominal paycheck went up. Let me introduce you to Sarah. She is not a real person, but a composite based on millions of real Americans in the same situation. Sarah is 34 years old. She is a registered nurse in a mid-sized city. She works full-time at a hospital. She's good at her job. She went to college, got her degree, did everything right. In 2010, when Sarah graduated, her starting salary was $55,000 per year. A starter home in her city cost about $180,000. That is 3.3 times her annual salary. She could not afford it immediately, but she could see a path. Save for a few years, get a down payment, buy a house, build equity. By 2024, Sarah is making $78,000. That sounds like a big raise. 42% increase over 14 years. She should be doing great, right? Wrong. That same starter home now costs $420,000. It is now 5.4 times her salary. The house moved away from her faster than her wages could catch up. But it gets worse. Her rent in 2010 was $850 per month. Today, it is $1,900. Her student loans, which she has been paying for 14 years, still have $28,000 remaining because interest ate most of her payments. Her health insurance, which used to be $150 per month through her employer, is now $340 per month. Groceries that cost $400 per month in 2010 now cost $900 per month. Gas, utilities, car insurance, everything has doubled or tripled. Her paycheck went up 42%. Her cost of living went up 110%. She's objectively poorer than when she started working 14 years ago, despite doing everything right. Sarah represents millions of Americans, teachers who cannot afford to live in the districts where they teach, firefighters who commute 2 hours because they cannot afford housing near their station, engineers who make six-figure salaries but still cannot save for a down payment. The middle class is not struggling because they are lazy or entitled. They are struggling because the Federal Reserve has been systematically devaluing their labor for over a century. The destruction did not stop with housing and wages. The Federal Reserve broke every major system that used to build middle-class wealth. Start with savings. In 1980, you could put money in a savings account and earn 12% interest annually. Real interest above inflation. Your money grew? Saving was a viable wealth-building strategy. Today, the average savings account pays 0.4% interest. Inflation is running at 3 to 7% depending on how you measure it. Your savings lose value every year you hold them. The Federal Reserve has made saving irrational. They have forced everyone into riskier investments, stocks, real estate, crypto, just to avoid having their wealth eaten by inflation. Next, pensions. In 1980, 60% of private sector workers had defined benefit pension plans. Your employer promised you a specific income in retirement based on your years of service. These were funded by conservative investments in bonds. But when the Federal Reserve dropped interest rates to near zero for over a decade, pension funds could not earn enough return to meet their obligations. Pension funds had to either cut benefits, demand more contributions, or take bigger risks. Most did all three. By 2024, only 4% of private sector workers have defined benefit pensions. Everyone else has 401ks, which shift all the risk onto the individual worker. Your retirement is now a gamble on stock market performance instead of a guaranteed income. Then college. In 1980, the average cost of college was $700 per year at a public university. You could pay for college with a part-time summer job. By 2024, the average cost is $28,000 per year. You need to take out massive loans that will follow you for decades. Why did this happen? Partly because the federal government made student loans unlimited and non-dischargeable. Colleges knew students could borrow any amount, so they raised prices to capture that money. This is inflation directly caused by monetary policy creating unlimited credit. Healthcare followed the same pattern. In 1980, the average American spent 3% of their income on healthcare. By 2024, it is 18% of income. Again, unlimited insurance money and government subsidies allowed medical costs to explode far beyond real increases in value or service. The Federal Reserve enabled all of this by keeping interest rates artificially low, making credit cheap and abundant, which inflated prices in every sector where credit is used: education, healthcare, housing, the three biggest expenses in American life, all inflated into unaffordability by monetary policy. But the destruction goes deeper than prices. The Federal Reserve fundamentally changed what kind of economy we have. Before 1971, when the dollar was still loosely tied to gold, there were limits on money creation. This forced discipline. The government could not run unlimited deficits. Banks could not create infinite credit. In 1971, Nixon severed the last link between the dollar and gold. The Fed was now completely unconstrained. What happened next? America began the largest debt binge in human history. Federal debt exploded from $400 billion in 1971 to $34 trillion today, an 85-fold increase. Corporate debt exploded from $500 billion to over $10 trillion. Household debt exploded from $500 billion to over $17 trillion. Total debt in the economy went from $1.5 trillion to over $90 trillion. We borrowed from the future to consume in the present, and the Federal Reserve enabled every dollar of it by keeping interest rates low and buying bonds whenever the market hesitated. This had a profound effect on the real economy. Why build a profitable business slowly when you can borrow cheap money and grow through acquisitions? Why invest in productivity and worker training when you can buy back your own stock and inflate the share price? Why manufacture products in America with expensive labor when you can borrow money, build a factory in China, and import the goods? The Federal Reserve made financial engineering more profitable than real engineering. They made asset price speculation more profitable than productive investment. They rewarded debt and punished savings. The result? America went from a nation that made things to a nation that manages financial assets. We went from a nation with a strong middle class of producers to a nation with a thin, wealthy class of asset owners and a large class of service workers. Manufacturing employment dropped from 25% of the workforce in 1970 to 8% today. Most of those lost jobs were middle-class jobs with benefits and pensions. They were replaced with service jobs, paying half as much with no benefits. The Federal Reserve did not directly ship those jobs to China, but their monetary policy made it profitable to do so. And every time the system threatened to collapse under the weight of all this debt, what did the Federal Reserve do? They printed more money. In 2008, the housing bubble burst. Banks had made trillions in bad loans. The financial system was insolvent. In a healthy economy, those banks would have failed. Their executives would have lost everything. Their shareholders would have been wiped out. Healthy banks would have bought their assets at bankruptcy prices. The system would have cleaned itself. Instead, the Federal Reserve bailed them out. They created $4 trillion and gave it to the banks. Not one major bank failed. Not one executive went to jail. The people who caused the crisis got bonuses. The people who played by the rules, who saved money and avoided debt, watched their savings lose value as the Fed inflated the currency to rescue the banks. In 2020, when COVID lockdowns threatened another crisis, the Fed did it again. They created $5 trillion in 18 months, the largest monetary expansion in American history. They called it emergency stimulus. But look at what happened to that money. The stock market hit all-time highs, while unemployment hit all-time highs. Billionaires gained $2 trillion in wealth, while 40% of small businesses closed permanently. Once again, the money flowed to those who owned assets, not those who needed help. The Federal Reserve has trained the wealthy to expect bailouts, to take massive risks, knowing the Fed will print money to save them if it goes wrong. This is called moral hazard. When you protect people from the consequences of bad decisions, they make more bad decisions. And who pays for these bailouts? You do. Through inflation, through the devaluation of every dollar you earn and save. You pay the cost of every bailout through reduced purchasing power. Now here's the historical parallel that should terrify you. This exact pattern has happened before, many times. The Roman Empire debased its currency to fund military spending. The result was hyperinflation, economic collapse, and the end of the empire. Weimar Germany printed money to pay war reparations. The result was hyperinflation, so severe that money became worthless within months. Zimbabwe printed money to fund government payrolls. The result was inflation of 89 sextillion% annually. Venezuela printed money to fund social programs without producing goods. The result was total economic collapse and mass starvation. Every single time in human history that a government has inflated its currency for long enough, the result has been collapse. Every single time, without exception. The United States believes it is different. We believe that because the dollar is the global reserve currency, we can print unlimited money without consequences. But the reserve currency status is not magic. It is based on trust. The trust that the dollar will hold its value. The trust that America will not inflate its currency into worthlessness. That trust is breaking. China and Russia now conduct most of their trade without dollars. BRICS nations are building alternative payment systems. Even American allies are reducing their dollar reserves. When the world stops needing dollars for trade, all those trillions we printed will come flooding back home, and we will experience the inflation we exported to the rest of the world for the last 50 years, all at once. The Federal Reserve will tell you this is necessary. They will tell you that printing money prevents recessions, saves jobs, stabilizes the economy. But look at the results. Since the Federal Reserve was created in 1913, the United States has had the Great Depression, the worst economic collapse in history. The stagflation of the 1970s, years of both high inflation and unemployment, something Keynesian economics said was impossible. The dot-com bubble burst of 2000 trillions in wealth destroyed. The 2008 financial crisis, the worst since the Great Depression. The 2020 economic crash, 30% of small businesses permanently destroyed. Every few years, another crisis, each one requiring more printed money to fix, each bailout creating the conditions for the next crisis. This is not stability. This is managed decline. The middle class is not disappearing because of automation or globalization or any other excuse politicians offer. The middle class is disappearing because the Federal Reserve has been systematically destroying the value of labor for over a century while protecting and inflating the value of assets. If you work for a living, you lose. If you own assets, you win. This is not a bug. This is the design. So what can you do? First, understand that the system is not designed to help you build wealth. It is designed to extract wealth from your labor and transfer it to asset owners. The game is rigged. Once you accept this, you can stop playing by their rules. Second, stop saving dollars. I know this sounds radical, but look at the math. Your savings account pays 0.4%. Inflation is 6%. You're losing 5.6% per year by saving dollars. The Federal Reserve has made saving irrational. Instead, convert your earnings into assets as quickly as possible. Real estate, stocks, skills, anything that cannot be inflated away. Third, understand that debt is the weapon they use to control you. Student loans, credit cards, mortgages, car loans. Debt that cannot be discharged in bankruptcy is a form of modern servitude. You work not to build wealth, but to service debt. Avoid it whenever possible. Fourth, recognize that your labor is being systematically devalued. A 3% raise when real inflation is 7% is a pay cut. Demand compensation that keeps pace with real price increases, not official inflation statistics. Fifth, do not expect the government to fix this. The Federal Reserve is the government's money printer. They will not shut it down. Both political parties love printing money because it lets them spend without raising taxes. Neither party will stop. The collapse is inevitable. The only question is timing. Rome took 200 years to fully collapse after they started debasing currency. America is moving much faster. We have gone from gold standard to infinite money printing in just 50 years. We are compressing centuries of monetary destruction into decades. The Federal Reserve destroyed the middle class through the quiet mechanism of inflation. They printed money that flowed to the wealthy and never reached workers. They made saving impossible, home ownership unaffordable, and wage growth meaningless. They did this deliberately, not through incompetence, but through design. The system works exactly as intended. It extracts wealth from labor and transfers it to capital, and every crisis makes it worse. What do you think happens next? Can this system survive another decade, another crisis? Or will we see the same collapse that destroyed Rome, Weimar, Zimbabwe, and Venezuela? Look at the debt levels. Look at the money printing. Look at your own purchasing power. Does this look sustainable? The Federal Reserve's greatest trick was making you believe that this is normal, that it has always been this hard, that your grandparents did not have it better. But they did. And the difference is the Federal Reserve. Comment below with your experience. Can you afford what your parents could at your age? If you want to understand how this system exports its inflation to the rest of the world, watch this video next. Subscribe to see how the largest wealth transfer in human history is happening right now, and nobody is talking about it.